Every time money leaves your trading account, it's not the market taking it. It's self-sabotage. Every hesitation, every doubt, every impulsive move is a choice you make, even if it feels out of your control. The setups can be perfect, the signals can align, but if the mind isn't disciplined, all of that potential slips away like sand through your fingers. This is the invisible force that keeps winning trades from becoming consistent profits, the hidden barrier between where you are now and where you could be. Self-sabotage doesn't scream, it whispers. It tells you to move your stop loss just this once. It tells you to enter early or chase a loss. It convinces you that following your plan is too slow or too cautious. It tricks you into thinking that one impulsive decision won't matter, when in reality, it compounds. Day after day, trade after trade, these small acts build a pattern of failure, and yet, they feel almost normal. They feel like trading. The harsh truth is that trading isn't lost because of strategies or systems. It's lost because of a mindset that isn't trained to act with discipline. Fear, greed, doubt, impatience. These emotions are more powerful than any indicator. They hijack rational thinking and turn potential profits into repeated losses. It's not luck. It's not the market. It's self-sabotage disguised as natural human reaction. Every missed opportunity, every premature exit, every impulsive entry carries the same message: the mind is in control. And if the mind isn't trained, consistent wins remain out of reach. Patterns of self-sabotage form without notice: hesitation at the perfect moment, overconfidence when risk is high, chasing after opportunities that feel too tempting. Each of these tiny mistakes is a choice, and each choice slowly erodes the possibility of consistent success. But there's another side to this. Self-sabotage can be recognized, it can be confronted, it can be stopped. Discipline can replace hesitation. Awareness can replace doubt. Rules can replace impulsivity. When the mind is trained to act decisively, consistently, and calmly, the same trades that once ended in frustration now become wins. Consistency doesn't come from prediction or luck. It comes from control, from breaking the patterns that have been holding back potential profits for too long. Every moment spent doubting, hesitating, or chasing losses is a moment where potential success slips away. But every moment spent observing, planning, and acting with discipline is a moment where winning becomes inevitable. The difference between repeating losses and achieving consistent success isn't external. It's internal. It's not found in charts or indicators. It's found in mastering the invisible, powerful force of the mind. The journey to consistent wins starts with one realization: self-sabotage is not a mistake, it's a habit. And habits can be broken. Every rule ignored, every impulse followed, every emotion indulged reinforces the old pattern. But when awareness steps in, when a new approach replaces old reflexes, the trajectory changes. Wins become more predictable. Losses become manageable. Trading stops being a roller coaster of frustration and becomes a process of steady, calculated growth. Stopping self-sabotage isn't about luck. It's about understanding the subtle ways the mind works against itself and consciously choosing a new path. Every hesitation avoided, every rule followed, every emotion controlled becomes a building block toward consistency. The momentum that once worked against progress now fuels it. Profits that once slipped away are now captured. Growth that once felt impossible becomes inevitable. Mastering these choices transforms trading from a cycle of frustration into a path of repeated success. The power to win consistently is already within reach. It's not in the market, it's not in the strategy, it's in the mind. Each decision, each pause, each act of discipline replaces the self-sabotage that has held results back. Every consistent choice compounds over time, creating a foundation of reliability, confidence, and success. Self-sabotage can be stopped. Winning consistently is no longer a dream, it's a skill that can be learned, practiced, and mastered. This is the turning point: recognition, awareness, control. Stop self-sabotage, build discipline, win consistently. The potential that has always existed in every trade is finally unlocked, not by luck, not by chance, but by mastering the most powerful tool, the mind itself. Self-sabotage is the invisible barrier that prevents traders from achieving consistent success, and it is far more powerful than most people realize. It does not announce itself with obvious mistakes or big, reckless decisions. Instead, it creeps in quietly, subtly shaping each trade, each decision, and each reaction in ways that gradually erode confidence, discipline, and account balances. It can appear in many forms, all of which seem almost harmless at first, but collectively create a pattern that keeps traders stuck in a cycle of repeated losses and frustration. One of the most common expressions of self-sabotage is exiting trades too early due to fear. A trade may appear perfect, with all conditions aligning according to the strategy, yet a sudden flicker of doubt or worry convinces the mind that taking profits immediately is safer than trusting the plan. Every time a trade is closed prematurely, the opportunity for maximum profit is lost, and the mind becomes conditioned to expect fear, reinforcing hesitation and creating a mental pattern that overrides logical decision-making. This simple act, repeated over days, weeks, and months, quietly trains the mind to prioritize avoidance over execution, safety over discipline, and fear over strategy, ensuring that consistent wins remain elusive. Self-sabotage can also manifest as overtrading in emotional states. When emotions like anger, frustration, disappointment, or even excitement enter the decision-making process, the mind begins to crave any action, rather than careful evaluation. Overtrading may feel productive in the moment. It provides a temporary sense of control or hope, but it actually amplifies risk, magnifies losses, and reinforces impulsive behavior. A trader may enter trade after trade without proper analysis, chasing the adrenaline of market movement rather than following a coherent plan. Overtrading in this way not only damages accounts, but also conditions the mind to associate trading with emotional highs and lows rather than disciplined execution. Another highly destructive form of self-sabotage is chasing losses or engaging in revenge trading. After a loss, the mind experiences a strong need for immediate restitution, a desire to regain what has been lost at any cost. This creates a dangerous compulsion to enter trades impulsively, ignoring the established rules of risk management and the strategy that was previously followed. Revenge trading is almost always counterproductive. It amplifies losses, heightens emotional stress, and embeds negative patterns that perpetuate frustration and fear. Each failed attempt to recover a loss reinforces the underlying belief that consistency is impossible, when in fact the cause lies entirely within the behavior itself, not the market or the strategy. Ignoring stop-loss rules is yet another subtle but devastating way self-sabotage takes hold. Stop losses are the most fundamental tool for controlling risk, yet the mind often rationalizes moving or removing them in the hope of avoiding small losses or letting a trade turn around. Each time a stop-loss is adjusted impulsively, the principle of risk control is broken, and the mind learns that risk management can be ignored. Over time, this erodes discipline and trains the brain to gamble with each trade rather than trade systematically. Similarly, entering trades impulsively without analysis is another clear form of self-sabotage. The desire to jump on sudden opportunities, to act on the fear of missing out, or to capitalize on emotional excitement often leads to trades that are not aligned with the strategy. Impulsive entries are rarely profitable and create a reinforcing loop of mistakes, losses, and frustration. Underlying all of these behaviors are psychological triggers that hijack rational thinking and dominate decision-making. Fear of loss is perhaps the most powerful. Humans naturally experience losses more intensely than equivalent gains, and this bias causes premature exits, avoidance of high-potential trades, and overcautious behavior that systematically reduces profitability. Impatience is another common trigger. The desire for immediate results and instant gratification pushes traders into hasty decisions, shortens time frames prematurely, and undermines the patience and discipline required for long-term success. Overconfidence also plays a major role. After experiencing a few small wins, the mind may inflate its sense of mastery and take unnecessary risks, ignoring analysis and deviating from the plan. Herd mentality and fear of missing out further compound the problem, convincing the mind to follow the crowd without evaluation. When the masses appear to be making profits, the urge to participate can override logic, discipline, and risk management, leading to impulsive trades and repeated mistakes. These triggers interact to form consistent patterns of self-sabotage that are often difficult to recognize. Without reflection, traders fail to notice recurring behaviors like premature exits, overtrading, impulsive entries, and ignored stop losses. Small errors, which may seem inconsequential individually, compound over time, slowly eroding profits and confidence. Over weeks and months, this creates a predictable cycle. Excitement at seeing opportunities sparks overconfidence, losses inevitably follow, frustration sets in, and impulsive revenge trades attempt to recover, restarting the cycle. This emotional trading loop, repeated endlessly, prevents consistent performance, regardless of the strategy's quality or market conditions. One reason self-sabotage goes unnoticed is its subtle and habitual nature. Repeated behaviors begin to feel normal, almost automatic, and the mind does not question them. Rationalization further obscures the problem, as the trader attributes losses to the market, bad luck, or flaws in the strategy rather than recognizing the role of their own behavior. Additionally, many traders lack emotional awareness, failing to notice how fear, impatience, overconfidence, and FOMO are influencing decisions in real time. Without this awareness, destructive patterns continue unconsciously, and the account continues to suffer. Understanding self-sabotage requires recognizing that it is not a single mistake but a system of behaviors, emotional reactions, and mental biases that collectively prevent consistent success. Each choice, hesitation, impulsive move, and rationalization contributes to the erosion of profits and confidence. Awareness, reflection, and deliberate action are necessary to break these patterns. By identifying how fear, impatience, overconfidence, and herd mentality affect each trade, a trader can begin to regain control, execute according to plan, and replace destructive habits with disciplined behaviors. Mastering self-sabotage is not about predicting the market or finding a better strategy. It is about mastering the mind, interrupting destructive cycles, and transforming every decision into a step toward consistent success. Once recognized, the patterns of self-sabotage can be corrected, emotional responses managed, and rational, disciplined execution restored. This awareness is the foundation for building confidence, protecting capital, and achieving consistent results over time, turning the potential for profit into actual, reliable outcomes. Most traders walk into the market believing the secret to success is hidden in the charts, in some complex strategy, or in an advanced indicator no one else has discovered yet. They spend countless nights testing, tweaking, jumping from one system to another, thinking maybe this time, maybe this tool, maybe this signal will finally unlock the profits they've been chasing. But the market has a way of humbling anyone who believes that success comes from complexity. The reality is simple but brutally honest. These strategies don't make traders consistent, mindsets do. You can hand two traders the exact same system. One will make it work, the other will destroy their account. The difference isn't the setup, it's the foundation. And those foundations are built on discipline, emotional awareness, long-term thinking, acceptance of losses, and confidence without ego. These are not optional skills, they are the silent weapons that separate amateurs who burn out from professionals who endure. Let me take you into the story of a trader named Arjun. He started like most beginners, obsessed with strategies. He bought expensive courses, downloaded endless indicators, and subscribed to every trading room he could find. His charts looked like a Christmas tree, moving averages, oscillators, Fibonacci retracements, Bollinger Bands, all stacked on top of each other. He thought the complexity would protect him, that the more information he had, the more certainty he could gain. But what happened? The more complicated his screen became, the more confused he got. He would see one indicator say buy, while another screamed sell. He would hesitate, overthink, miss the entry, or worse, enter at the wrong time. Eventually, frustration pushed him to break his own rules. He started taking trades out of anger, holding trades out of hope, and risking more than he should. His account drained slowly but consistently. And then, one day it hit him: the problem wasn't the strategy. The problem was him. Discipline over strategy, that was his turning point. He stripped his chart bare, down to a simple plan. Just one setup, one risk rule, one routine. But this time he promised himself something different. No matter what happened, win, lose, sideways market, he would follow his rules exactly. And that's when everything changed. Because discipline beats strategy every single time. Think about it, even the most brilliant system is useless if you can't stick to it. The market doesn't reward creativity, it rewards consistency. The trader who follows a simple set of rules with discipline will always outlast the trader who chases complexity without control. Discipline means you stop moving your stop loss when fear creeps in. Discipline means you don't add to a losing position just because you can't accept being wrong. Discipline means you risk the same percentage every trade, no matter how certain you feel. It's boring, it's repetitive, but it's exactly that boring consistency that builds wealth. And Arjun finally understood it wasn't about being smarter, it was about being steadier. But discipline alone wasn't enough. The second foundation he had to face was emotional awareness. The truth is, the market isn't just a place of numbers and charts, it's an amplifier of emotions. Every tick of price, every green candle, every red candle is like a mirror reflecting what's going on inside you. Fear, greed, frustration, impatience. These emotions are powerful, and they don't just whisper, they scream. Fear tells you to exit too early. Greed tells you to hold too long. Frustration shoves you into revenge trades. Impatience whispers that you should click the button even when no setup exists. And here's the thing, most traders think they're logical, but really they're emotional creatures reacting to flashing numbers on a screen. Arjun learned this the hard way. After 3 winning trades, he felt unstoppable. His chest swelled with confidence. His mouse clicks grew bolder, his position sizes doubled. And then the market slapped him. One trade erased all his gains. He stared at the screen, heart racing, telling himself, I just need one trade to get it back. He entered recklessly and the spiral continued. This wasn't strategy, it was raw emotion running wild. That's when he discovered a powerful tool. Journaling. He began writing before every trade, during the trade, and after it. He'd jot down things like, I feel nervous, I don't want to miss this move. Or, I feel greedy, I want to make up for the last loss. Over time, patterns emerged. He realized he always got reckless after 3 wins. He noticed he took revenge trades after one big loss. That awareness gave him control. Once he could name the emotion, he could pause and decide. It was like putting a spotlight on the monster under the bed. It stopped being so scary. Awareness created space between impulse and action, and that space was where consistency lived. The third foundation Arjun embraced was long-term thinking. Like so many traders, he used to crave quick wins. He wanted to double his account in a month. He measured success in single trades, single days. And every time he lost, it felt like the end of the world. But then he shifted perspective. Trading wasn't a lottery ticket. It was a process, like planting a tree. You don't throw a seed in the ground and expect fruit tomorrow. You water it, protect it, wait patiently, and over time it grows strong. That's what trading is, small wins stacked patiently. A 1% gain may feel tiny today, but compounded over years it becomes life-changing. Once he adopted this mindset, he stopped caring so much about one trade. He stopped panicking over one losing day. He started asking, how am I doing over 100 trades? Over 6 months? Over a year? This zoomed-out perspective freed him from the noise and allowed him to focus on steady, consistent growth. The market is designed to test your patience, to lure you into short-term traps. Long-term thinking is the shield that protects you. Still, even with discipline, awareness, and patience, losses remained. And that's where the fourth foundation came in: acceptance of losses. This one was the hardest. Every time Arjun lost, he used to feel like a failure. He took it personally, as if the market was attacking him. But then he realized, losses aren't failures, they're fees. Just like a business pays rent, electricity, and salaries, traders pay with losses. They are the cost of doing business. The difference is how you interpret them. For Arjun, the shift happened when he stopped asking, did I win? And started asking, did I follow my process? Suddenly, even a losing trade could be a victory if it was executed according to his rules. This reframing was powerful. It meant losses no longer crushed his confidence. They became feedback instead of judgment. Every professional trader you admire, every hedge fund manager, every seasoned veteran, they all lose trades. The difference is, they don't fear them, they don't avoid them, they accept them as part of the journey. When you stop fighting losses, you stop being desperate, you stop chasing, you start trading with clarity. Finally, the last foundation: confidence without ego. Confidence is essential in trading. Without it, you'll hesitate, miss entries, or second-guess yourself out of profits. But confidence has a dangerous twin called ego. Ego whispers after a winning streak, you can't lose. You're smarter than the market. Double your size, go all in. Ego inflates blinds and then destroys. And the market loves nothing more than to humble an ego-driven trader. Arjun learned humility when, after a string of wins, he threw risk management out the window. He told himself, this setup can't fail. It failed. One trade wiped out weeks of steady gains. He sat staring at the screen, realizing his problem wasn't knowledge, it was arrogance. True confidence is quiet, it's steady. It doesn't swing wildly between euphoria and despair. It's the calm belief that you can follow your rules no matter what. It's backed not by luck, but by discipline, awareness, patience, and acceptance. True confidence walks hand in hand with humility. It says, I trust myself, but I respect the market. That balance is what keeps you alive. So here's the truth: consistent trading isn't about finding the holy grail strategy. It's about building the holy grail mindset. Discipline makes sure you follow your plan. Emotional awareness protects you from the traps of fear and greed. Long-term thinking helps you stay patient and see the bigger picture. Acceptance of losses frees you from frustration and self-judgment. And confidence without ego allows you to trade with strength while staying humble. These aren't just trading lessons, they're life lessons. Because trading is the ultimate mirror. It reflects back who you are. If you're disciplined, patient, humble, and resilient, the market will reward you. If you're reckless, impatient, emotional, and arrogant, the market will punish you. The choice is yours. And as you listen to this, maybe you're thinking about your own journey. Maybe you've felt the sting of losses that felt personal. Maybe you've chased trades out of frustration. Maybe you've doubled your size after a win, only to lose it all the next day. You're not alone. Every trader walks this path. The difference between those who quit and those who succeed is mindset. Build these foundations and you will not only survive, you will thrive. The strategy is just the tool. The mindset is the hand that wields it. And remember, in trading, you don't need to predict the future. You just need to manage yourself in the present. So here's my challenge to you: choose one of these foundations and start today. Maybe you start journaling your emotions. Maybe you commit to never breaking your stop-loss rule. Maybe you practice patience by skipping trades that don't align with your plan. Small steps create massive results over time. Because in the end, your biggest edge isn't on the chart, it's in you. The market doesn't reward the smartest trader. It rewards the most disciplined, the most patient, the most aware, the most humble. Build those foundations, and consistency will follow. Every trader dreams of consistency. They dream of turning the chaos of the markets into a steady flow of income, of building something reliable out of something unpredictable. But if you've been in trading for any length of time, you know the brutal truth: it's not the market that destroys most traders, it's the traders themselves. The biggest enemy isn't volatility, isn't manipulation, isn't even a bad strategy. The biggest enemy is self-sabotage. And that's why today we're going to build something powerful together, a self-sabotage-proof trading plan. Not just a set of rules written on paper, but a living structure that protects you from yourself. Because in trading, you don't rise to the level of your strategy, you fall to the level of your discipline. And a proper plan is what keeps you from falling. Let me take you back to the story of Daniel, a trader who had everything going for him: intelligence, passion, and access to some of the best strategies in the game. But despite all that, he could never hold on to profits. Every time he built his account up, it would crash back down. Why? Because Daniel was sabotaging himself. He'd enter trades outside of his rules because he felt good about it. He'd move his stop-loss just a little lower because the market might turn. He'd risk twice as much after a winning streak because this one looks perfect. On the surface, he was trading, but really, he was gambling. The turning point came when he realized something critical: he didn't need a new strategy. He needed a self-sabotage-proof plan. And when he built one, everything changed. The first step in building such a plan is defining your strategy clearly. Too many traders trade with blurry lines. Their entry rules are vague. I'll buy when the market looks bullish. Their exits are based on feeling. I'll close when it feels overextended. Their stop losses and targets shift depending on their mood. That vagueness is an open invitation for sabotage. A proper plan leaves no room for guesswork. You write down your entry rules like you're explaining them to someone who has never seen a chart before. For example, I enter long when the 50-day moving average crosses above the 200-day and price closes above the last swing high. That's specific. For exits, you write, I exit when the RSI hits 70 or when price closes below the 20-day moving average. Again, specific. Your stop loss. Not, I'll put it where it feels safe. But, my stop loss goes 1% below the last swing low, or exactly 2 times the ATR. Take profit. I aim for 2v1 reward to risk every time, no exceptions. The clearer the rules, the less room there is for your emotions to rewrite them. Think of your strategy like a pilot's checklist. A pilot doesn't say, I'll take off when the plane feels ready. No, they check each step in detail, every single time. Your trading deserves the same precision. But defining entries and exits is only half the battle. The real battlefield of trading lies in risk. And that's why the second foundation of a sabotage-proof plan is setting risk limits. Let's be honest. Nothing tempts traders to sabotage themselves more than risk. One winning trade, and suddenly you want to double your size. One losing trade, and suddenly you want to make it back with twice the leverage. Without risk rules, your emotions will hijack your account. That's why you need non-negotiable limits. The first is per trade risk. What percentage of your account are you willing to lose on a single trade? Professionals keep it small, usually 1% or less. That means even if you lose 10 trades in a row, you're still alive. Then you set daily risk caps. For example, if I lose 3% in a single day, I stop trading, no exceptions. Why? Because after a string of losses, emotions take over. You think you're trading, but you're just fighting the market. A daily cap is your circuit breaker. You also need weekly and monthly caps. If you hit your weekly drawdown limit, you stop. If you hit your monthly, you step back and review. These limits aren't about weakness, they're about survival. Imagine a boxer. No matter how good he is, if he refuses to guard his face, he won't last long. Risk rules are your guard. They protect you from the knockout punch that ends most traders' careers. Once your risk is defined, you need structure around your time. That's where a trading schedule comes in. Trading without a schedule is like playing a sport without rules. You show up randomly, take trades whenever you feel like it, and wonder why your performance is inconsistent. A sabotage-proof plan has fixed trading hours. You decide in advance, I will trade from 8 a.m. to 11 a.m. and from 1 p.m. to 3 p.m. That's it. Why? Because fatigue is a silent killer. The longer you stare at charts, the weaker your decision-making becomes. Late at night, tired, emotional, hungry, you're vulnerable. That's when impulsive trades sneak in. A trading schedule protects you. It creates boundaries so the market doesn't consume your whole life. It also keeps you from overtrading. When the bell rings, you walk away. No, just one more. No, let me check after dinner. Imagine a surgeon, they don't operate 24/7. They have scheduled hours, rest, and recovery. Because they know fatigue leads to mistakes. Why should trading be any different? By fixing your hours, you train your mind and body to perform at peak focus when it matters most. Even with clear rules, solid risk limits, and a structured schedule, there's still one wild card left: your emotions. That's why your plan must include emotional rules. Every trader has those days where frustration bowls over, where anger takes control, where you feel like the market is laughing at you. If you don't set emotional boundaries, those feelings will drag you into self-sabotage. The rule is simple: stop trading when frustrated or angry. Not later, not after one more trade, immediately. If your hands are shaking, if your heart is racing, if your inner voice is screaming, get it back. You walk away. Trading in that state is financial suicide. Another emotional rule is recognizing patterns. Maybe you always get reckless after 3 wins in a row. Maybe you always revenge trade after one big loss. Write those down. Make them part of your plan. For example, if I have 3 wins in a row, I reduce my position size on the next trade. Or, if I take a loss bigger than 2%, I stop for the day. These rules turn your weaknesses into guardrails. They don't eliminate emotion, but they stop emotion from driving the car. And finally, the last piece of the sabotage-proof puzzle is accountability systems. Because let's be real, on your own, you can justify anything. You'll tell yourself stories, make excuses, twist the truth. That's why you need systems that force honesty. The first is journaling. Every trade, every emotion, every decision gets written down. Not just the numbers, but the feelings. I entered early because I was scared of missing out. I doubled my risk because I felt overconfident. Over time, the journal becomes a mirror. It shows you patterns you can't see in the moment. The second is regular reviews. Once a week, once a month, you sit down and analyze. Did you follow your rules? Where did you break them? How did your emotions play into it? And the third layer is external accountability. Maybe it's a trading buddy. Maybe it's a mentor. Maybe it's even a community. The point is, someone else sees your progress. Someone else calls you out when you break your rules. Accountability makes it harder to lie to yourself. It keeps you aligned with the process when emotions try to pull you away. So let's put this all together. A self-sabotage-proof trading plan isn't about being perfect. It's about building a structure so strong that even when your emotions flare, even when discipline slips, even when fatigue sets in, you're protected. You define your strategy clearly, so there's no room for, "I'll just wing it." You set risk limits, so one mistake can't end your career. You fix your trading schedule, so fatigue and impulsiveness can't creep in. You add emotional rules, so you know when to stop before disaster strikes. And you build accountability systems, so you're never blind to your own patterns. Think of it like building a fortress. The market will test your walls. Fear will attack the gates. Greed will try to slip through the cracks. Frustration will hammer at the doors. But if your fortress is strong, you hold steady. And over time, while others fall to sabotage, you stand tall. Remember this: the market doesn't need to beat you. You'll beat yourself if you don't prepare. But with the right plan, you can step out of your own way. You can stop sabotaging your success. And once that happens, consistency isn't just possible, it's inevitable. So here's my challenge to you: sit down and write your plan. Define your entries, exits, stops, and targets in detail. Set your risk per trade, your daily, weekly, and monthly caps. Choose your trading hours, and commit to walking away when time is up. Write down your emotional triggers, and create rules to stop them in their tracks. Start journaling, reviewing, and building accountability. Don't just think about it. Don't just plan it in your head. Write it, make it real. Because in trading, vague plans create vague results. Clarity creates consistency. At the end of the day, a self-sabotage-proof plan isn't about locking yourself in a cage. It's about giving yourself freedom. Freedom from overthinking, freedom from fear, freedom from the endless cycle of building up and blowing up. It's about creating a structure that keeps you safe so your growth can finally compound. Because the truth is, the market will always test you. The question is, will you sabotage yourself, or will you stand strong inside the fortress you built? The choice is yours. Every trader has been there. You do your research, you prepare your charts, you promise yourself you stay disciplined this time. And yet, a few hours later, you've taken a trade you never planned, moved your stop loss because you felt like it, or doubled down after a losing streak. You look back and ask yourself, why did I just do that? I knew better. That's the cruel reality of trading. It's not always the market that beats us. Most of the time, it's us sabotaging ourselves. And until you master this inner battle, no strategy in the world will save you. Today, we're going to talk about practical techniques to stop self-sabotage. Not vague advice, but real tools you can start using today to break the cycle. The first and most critical step is awareness and recognition. You cannot fix what you don't see. Most traders operate on autopilot, letting emotions slip past their radar until it's too late. They tell themselves, "I'll be fine," while deep down they're already setting up the next self-sabotaging move. The key is to identify your personal triggers. For some, it's boredom, sitting too long at the screen until impatience forces them into a trade. For others, it's revenge, that burning need to get back at the market after a loss. Maybe your trigger is FOMO, that panic when you see a move running without you. The trick is to name them. Write them down. Don't just say, "I need to control my emotions." Say, "When I feel left behind, I chase trades. When I lose 3 times in a row, I increase my size. When I win big, I get reckless." By naming the pattern, you strip it of its hidden power. Pair this with a daily self-check before trading. Take 2 minutes and ask yourself, am I calm? Am I clear? Am I trading because I see my setup, or because I feel pressure? That quick check-in is like scanning your dashboard before driving. If the warning light is on, you don't hit the gas. You pause. You reset. Awareness is your first line of defense. Once you recognize your triggers, the next tool is mindfulness and meditation. Now, I know some traders roll their eyes when they hear these words, but stick with me. The market is chaotic, charts move fast, price action is unpredictable. The only stability you can control is your own state of mind. Mindfulness isn't about chanting or sitting cross-legged for an hour. It's about training your brain to stay calm in the storm. One powerful technique is the 4-7-8 breathing method. When you feel stress rising, inhale through your nose for 4 seconds. Hold for 7. Exhale slowly for 8. Repeat this 3 times. What does it do? It slows your heart rate, calms your nervous system, and gives your rational brain a chance to take back control from the emotional brain that wants to sabotage you. Another method is simple awareness practice. While waiting for a setup, notice your thoughts without judging them. I feel anxious. I feel greedy. I feel impatient. By observing the emotion instead of fusing with it, you weaken its grip. Even a 2-minute meditation before trading can shift your entire session. Think of it like sharpening a sword before battle. The calmer you are, the sharper your decisions become. But awareness and calmness aren't enough on their own. That's why you need visualizations and pre-trade preparation. Athletes do it before every big game. Pilots do it before every flight. And traders should do it before every session. The idea is to mentally rehearse not just your trades, but your emotional responses. Before the market opens, close your eyes and imagine, if price goes against me, I will calmly accept the stop loss and move on. Imagine, if I miss a trade, I will not chase. I will wait for the next setup. Picture yourself following the plan step by step, even in tough scenarios. Why is this so powerful? Because your brain doesn't fully distinguish between mental rehearsal and real experience. By visualizing discipline, you create a memory of it, so when the real situation comes, it feels familiar. You've already handled it in your mind. You can also rehearse positive outcomes. Imagine yourself executing a perfect trade according to plan, closing the chart, and walking away with pride. Not because you won, but because you stuck to discipline. This kind of mental conditioning builds resilience. Instead of reacting blindly, you're prepared, and that leads us to routine and rituals. Inconsistent behavior creates inconsistent results. A trader without rituals is like an athlete who skips warm-ups, vulnerable, distracted, and unprepared. Successful traders build consistent pre-trading routines that reinforce discipline. Maybe it's reviewing your trading plan. Maybe it's a short meditation. Maybe it's checking your journal and reminding yourself of last week's mistakes. The point isn't what the ritual is. The point is that it's consistent. A ritual signals to your brain, it's time to trade. It's time to be focused. Think about Michael Phelps, the Olympic swimmer. Before every race, he followed the same ritual, down to the smallest detail. It wasn't superstition. It was conditioning. By the time he dove into the pool, his body and mind were already in peak state. Your trading deserves the same consistency. Along with rituals, you need to protect your environment. Remove distractions. No phone buzzing with notifications. No TV in the background. No multitasking. The market demands your full attention. A single distraction can trigger a chain of self-sabotage. Your routine and environment are your shield against chaos. Now, even with strong routines, you need a way to measure your progress. That's where journals come in. Not the generic, "I entered here, I exited there" kind of journal, but a living record of your behavior. Every entry should include your entry and exit, yes, but also your emotion and your lesson. Right, I entered early because I was impatient. I felt anxious. I moved my stop because I was afraid of losing. This level of honesty is uncomfortable, but it's powerful. Over time, you'll start to see recurring patterns. Maybe you realize that most of your bad trades happen late at night, or maybe you notice that your biggest losses always follow a big win. Without journaling, you'll never see these patterns clearly. Pair this with weekly reviews. Sit down once a week and ask, what mistakes repeated? What emotions dominated? What rules did I break? Review not to beat yourself up, but to identify and learn. Think of your journal as a personal coach. It doesn't lie. It doesn't flatter. It just shows you the truth, and that truth is the key to breaking sabotage cycles. Finally, let's talk about positive reinforcement. Most traders only reward themselves when they make money, but that mindset keeps you stuck in sabotage because it trains your brain to value profit over discipline. Instead, flip the script. Reward yourself for disciplined trades, not just profitable ones. Did you stick to your stop loss even though it hurt? Reward yourself. Did you skip a trade because it didn't meet your rules, even though it looked tempting? Reward yourself. This trains your brain to associate discipline with success. You start to crave good behavior, not just good outcomes. And this is critical because markets are random in the short term. You can make money from a bad decision, and you can lose money from a good one. If you only reinforce outcomes, you'll sabotage yourself chasing quick wins. But if you reinforce behavior, you'll build habits that last. One trader I know literally keeps a jar on his desk. Every time he follows his plan with discipline, he drops a coin in. At the end of the month, he uses that jar to buy himself something nice. It sounds silly, but it works. Because the brain loves rewards, no matter how small. Use that to your advantage. So let's put this all together. Stopping self-sabotage isn't about superhuman willpower. It's about using tools to protect yourself from yourself. You start with awareness, identifying your personal triggers and doing a daily self-check. Then you use mindfulness and meditation to calm the storm before it takes over. You rehearse your discipline with visualizations, so when pressure hits, you're ready. You create routines and rituals that anchor your focus and protect you from distractions. You keep a journal that tells the truth about your behavior, and you review it weekly to catch patterns before they repeat. And you reinforce discipline with rewards, so your brain starts craving the right behaviors instead of sabotaging ones. Remember, this trading is not just numbers and charts. It's a psychological marathon. Every day, you are racing against yourself. And the traders who last, the ones who survive and thrive, aren't the ones with the fanciest strategies. They're the ones who master themselves. They're the ones who build habits, rituals, and tools to stop self-sabotage before it destroys them. So here's my challenge for you. Starting today, pick one of these techniques and implement it. Don't try to do all of them at once. Just start with one. Maybe it's journaling. Maybe it's a breathing exercise. Maybe it's a daily self-check. Practice it until it becomes natural. Then add another. Over time, you'll notice something powerful. The sabotage that once felt automatic begins to lose its grip. The triggers that once controlled you begin to fade, and you start to experience something most traders never feel: freedom. Freedom from the cycle of building up and blowing up. Freedom from regret. Freedom to finally see your edge play out the way it was meant to. Because in the end, self-sabotage doesn't have to be your story. With awareness, mindfulness, visualization, routines, journaling, and reinforcement, you can rewrite the script. You can stop being your own worst enemy and start being your greatest ally. And when that happens, the market doesn't stand a chance. Every trader has felt it, the roller coaster of emotions that seems to control your decisions more than your strategy does. One moment, you're excited, convinced you've spotted the perfect setup. The next, that excitement turns into overconfidence. You take a bigger risk, maybe even ignore your plan, and then the loss comes. Suddenly the chart feels like your enemy. Frustration builds. You want to make the money back right now, so you jump into another trade without thinking. That impulsive decision digs the hole even deeper. This is the emotional cycle of trading, and if you don't learn to manage it, it will repeat over and over until your account and your confidence are drained. So, how do you break free? The first step is understanding the cycle itself. Excitement, overconfidence, loss, frustration, impulsive trades. These 5 stages feed into each other like gears in a machine. The high of a winning streak makes you careless. The sting of a loss makes you chase, and the chasing leads to bigger mistakes. Once you see this pattern clearly, you realize you don't have a market problem, you have a cycle problem, and cycles can be broken. One of the simplest, yet most powerful techniques is to step back after a loss. Think about it: when you lose money, your brain is flooded with stress hormones. You're not thinking clearly, you're reacting. And reacting is the root of sabotage. Instead of jumping straight into another trade, set a rules after every loss. You step away for 10 or 15 minutes. Walk around, drink some water. Let your nervous system reset. If you're struggling with discipline, use timers or alerts. Physically block yourself from making an immediate reaction trade. Give yourself space to return with logic instead of emotion. This simple pause can save you from turning one small loss into a devastating spiral. But managing emotions isn't just about pausing. It's also about reshaping the way you think. This is where cognitive restructuring comes in, the art of changing destructive thoughts into objective analysis. For example, instead of saying, "I'm such a failure, I can't believe I lost again," replace it with, "This is a trade, not a test of my worth." Instead of, "The market is against me," say, "This trade didn't fit my plan. The next one might." Words matter, because the way you talk to yourself shapes the way you act. When you make your thoughts more objective, you prevent emotions from dragging you deeper into the cycle. You stop personalizing every trade and start seeing them for what they are: probabilities playing out. Now let's address greed, because greed is one of the biggest fuel sources of the cycle. It sneaks in after a winning streak, whispering, "Go bigger, risk more, double your profits." And it feels good in the moment, until one trade wipes away everything you've built. The antidote is clear rules for profit taking and leverage. Decide before you enter how much you're willing to risk and how much profit you'll take. Write it down. Then, when greed tempts you to hold just a little longer or to increase your size without reason, you can return to the plan. Remind yourself your edge comes from consistency, not one lucky trade. Over-leveraging is not ambition, it's sabotage in disguise. On the flip side, we have fear. Fear is what makes you exit too soon. Fear is what keeps you from taking valid setups because you're haunted by past losses. And fear, if left unchecked, can paralyze you. The key is to accept that losses are part of trading. They don't mean you're broken. They don't mean your system is broken. They mean probability is playing out. No strategy wins 100% of the time. And no trader in history has avoided losses. The way to control fear is to focus on your statistical edge, not on any single outcome. One trade doesn't define you. 10 trades don't define you. What matters is the long-term curve. If your system has an edge, the losses are simply stepping stones to the bigger picture. Managing emotional cycles doesn't mean you'll never feel excitement, greed, fear, or frustration again. It means you'll learn to recognize them without letting them take over. It means you'll have tools, stepping back, using timers, restructuring your thoughts, sticking to profit rules, focusing on your edge, that protect you when emotions flare. Think of it this way: the market is like the ocean. You can't stop the waves from coming, but you can learn to surf them. The emotional cycle will always exist, but when you manage it, you stop drowning in it. You ride it with balance, patience, and clarity, and that's when consistency becomes possible. Because in the end, trading success isn't about eliminating emotions. It's about mastering them. It's about stepping off the roller coaster and taking control of the ride. Most traders don't fail because they don't know enough. They fail because they can't stay consistent. Think about that. It's not the lack of strategies. It's not the lack of indicators. It's the inability to do the right thing again and again and again. But here's the hidden truth: consistency isn't built on luck or knowledge. It's built on discipline. And discipline isn't sexy. It's boring, it's repetitive. It feels like small steps that don't matter. But over time, those small steps are the very thing that separates the 5% who survive from the 95% who quit. Let me paint you a picture. Imagine two traders. The first trader wakes up every morning hunting for the big trade. He wants that one lightning strike that will double his account. And when he wins, it feels incredible. But when he loses, and he will, it wipes out weeks of progress. His equity curve looks like a roller coaster, and so do his emotions. He's chasing, hoping, guessing. Now picture the second trader. He doesn't hunt for the jackpot. He doesn't care about flashy wins. He only cares about one thing: following his rules. He takes his setups, he respects his stop losses, and he logs out when the session is done. His gains are small. Sometimes they even look boring. But here's what happens: while the first trader is repairing damage, the second trader is stacking bricks. Every brick is a small win. And day by day, those bricks build a wall of consistency. This is the first key to consistency: small wins compound. A 1% gain every day doesn't feel exciting. But stack it for weeks and months, and suddenly your account and your mindset look completely different. Because every time you follow your rules, you're proving to yourself that you can be trusted. And self-trust is the foundation of consistency. But how do you know if you're truly getting consistent? This is where metrics come in, and I don't just mean profit and loss. P&L is surface level. Real consistency lives in the deeper numbers. Look at your win-loss ratio. Not because higher is better. It's not. A trader with a 40% win rate can be profitable if their risk-to-reward ratio is right. Which brings me to the second number, your average risk-to-reward ratio. Are you risking 1 to make 2, or are you risking $2 to make 1? Over time, this number will expose whether your strategy actually has an edge. And here's the hidden metric nobody tracks: your emotional control score. Every day, after you finish trading, score yourself out of 10. Did you follow the rules? Did you avoid revenge trades? Did you respect your stop loss? Did you cut winners too early because of fear? This score matters more than your balance. Why? Because your emotions are the engine behind every single decision you make. And if you can't control that engine, you can't build consistency. But here's where traders sabotage themselves. They keep overcomplicating. They can't sit still with one strategy. They add indicators, they tweak their system after every loss, they reinvent the wheel every other week. And what happens? They never give their edge a chance to play out. Listen closely: consistency doesn't come from complexity. It comes from simplicity. A simple plan executed with discipline will always outperform a complicated plan executed inconsistently. Your job isn't to keep inventing new strategies. Your job is to make your existing strategy boringly repeatable, because boring equals consistent. And this brings me to the secret weapon almost nobody uses: reviews. Daily reviews, weekly reviews. Most traders lose and immediately blame the market. Oh, it was choppy. Oh, news ruined it. Oh, algos manipulated price. But the market isn't against you. The market doesn't even know you exist. The real enemy is within. So here's what you do after every trading day: review yourself. Ask, did I follow my rules? Did I overtrade? Did I take setups out of boredom or FOMO? This isn't about shaming yourself. It's about clarity. Then at the end of the week, zoom out. Look for patterns. Maybe you realize you break rules most on Mondays, or that you trade recklessly after a big win. These insights are gold. They reveal the behavioral patterns that destroy consistency. And once you see them, you can fix them. Not by rewriting your strategy every week, but by tweaking your habits. Here's the bottom line: consistency is built, not found. It's built by stacking small wins. It's measured through your metrics, not your ego. It's strengthened by keeping things simple. And it's refined by reviewing yourself with brutal honesty. So let me ask you, do you want to be the trader who chases jackpots, riding the highs and crashing with the lows? Or do you want to be the trader who stacks bricks, slowly, steadily, building a wall of consistency that can't be knocked down? Because at the end of the day, consistency isn't about the market. It's about you, your habits, your discipline, your ability to show up, follow your plan, and trust yourself. The traders who last aren't the ones who catch the biggest wins. They're the ones who build small wins, day after day, until consistency becomes their identity. And that choice is in your hands. Most traders believe their biggest enemy is the market. But the truth is, the environment you trade in can either protect you or sabotage you. If your surroundings are filled with distractions, noise, and emotional triggers, it doesn't matter how good your strategy is. You'll keep slipping into self-sabotage. Creating a self-sabotage-free trading environment isn't just about having the right tools. It's about building the right atmosphere that keeps you disciplined, focused, and calm. First, let's talk about distractions. Picture this: you're in a trade, monitoring the chart, and suddenly your phone buzzes. A friend sends you a random message, or you see breaking news on social media. Your attention breaks for just a moment, but that moment is enough to trigger doubt or fear. Maybe you jump out of a trade too early. Maybe you jump into a trade you never planned. A distracted mind cannot trade with precision. That's why every serious trader needs a dedicated workspace. Not a couch, not a bed, but a space that signals to your brain, this is trading time. Keep it clean, free of clutter and free of unrelated devices. During your trading hours, shut down social media, mute notifications, and avoid news overload. Remember, more information isn't better. Clarity is better. Your edge comes from focus, not from drowning in noise. Next, technology management. Technology can either empower you or destroy you. If you're glued to the screen, constantly checking every tick, you'll make impulsive decisions. But if you use technology wisely, it becomes your ally. Set alerts to notify you only when your setup is forming, so you don't waste energy staring at the screen all day. Use automation where possible, like stop-loss orders and take profits, so emotion doesn't get a chance to interfere once you're in the trade. Turn off unnecessary notifications that drag you into herd mentality. Don't let your phone or platform pull you into impulsive actions. Make it work for you, not against you. Now let's address something most traders overlook: surrounding yourself with discipline. Trading can be lonely, and loneliness often breeds bad habits. When no one is watching, it's easy to break your own rules. But imagine if you had accountability partners, people who, just like you, are striving to trade with discipline. A community that reinforces good habits, not bad ones. This could be a trading group, a mentor, or even just one partner you check in with daily. When you know someone else will see your journal or ask about your trades, you're far less likely to take reckless bets. Discipline multiplies when it's shared. Finally, one of the biggest traps: herd mentality. Nothing sabotages traders faster than following the crowd. You see it all the time: social media influencers screaming about a sure thing, news channels hyping up volatility, forums filled with fear and greed. If you fall into that noise, you stop trading your plan and start trading their emotions. And here's the harsh truth: the herd always loses. The only way to survive in this game is to detach from the noise and stick to your plan. If your analysis says no trade, then no trade. If your rules say take profit, then take profit. Not because Twitter said so, not because the news said so, but because your discipline demands it. At the end of the day, creating a self-sabotage-free trading environment is about protecting your mind. Eliminate distractions so you can stay present. Manage technology so it helps you instead of controls you. Surround yourself with people who build you up, not drag you down. And most importantly, trade your plan, not the crowd. Because in trading, your environment is either sharpening your discipline or silently sabotaging it. The choice is yours. Imagine two traders, both sitting in front of their screens at 900 a.m., both staring at the same chart, both with the same tools. One will sabotage himself into losses, the other will quietly build consistency. The difference: it's not luck, it's not strategy, it's mindset and discipline. Meet Adam. He's been trading for 2 years. He knows technicals, he knows indicators, he's read all the books. But knowledge isn't his problem, control is. One Monday morning, Adam spots a setup on EURUSD. His plan says he should risk no more than 1% of his account per trade. But he feels different today. He's been losing all week, and he wants to make it back in one shot. His brain whispers, just this once, double the position size. If it works, you'll cover your losses instantly. He listens. At first, the trade moves in his favor. His heart races. He imagines the relief, the story he'll tell himself about bouncing back. But markets don't care about his hopes. Within minutes, the price reverses. His stop loss gets hit. Because he doubled the risk, this single trade wipes out 5% of his account. Frustration hits hard. Instead of stepping back, Adam feels the urge to get it back. He takes another trade, impulsive, unplanned, based only on emotion. That one loses too. By the end of the day, he's down 12%. Here's the painful part: Adam didn't lose because his strategy was bad. He lost because he broke his own rules. He sabotaged himself by chasing, by letting fear and frustration take the wheel. And the cycle repeats. Every time he tries to make it back, he digs deeper. His account shrinks. Worse, his confidence shatters. The more he sabotages himself, the more trading feels like chaos. Now let's meet Sarah. She trades the same markets Adam does. She faces the same setups, the same temptations. But her approach is different. On that same Monday morning, Sarah also sees a setup on EURUSD. Her trading plan tells her risk 1% of the account, stop loss at a defined level, take profit at 2-on-1 reward to risk. Nothing fancy, just her system. The trade doesn't go her way. It hits stop loss. She's down 1%. But here's the key: Sarah doesn't panic. She doesn't double her risk on the next trade. She doesn't take revenge trades. She simply writes in her journal, trade followed plan, loss within rules, emotion, mild frustration. She closes the laptop and takes a break. The next day, she takes another trade, again following her plan. This time it wins. 2 units of profit. Now she's up 1% overall, despite the losing start. By the end of the week, her account shows a modest gain of 2%. That number isn't flashy. But here's the difference: as Sarah is in control. Her confidence grows, not because she never loses, but because she knows she can trust herself to follow the rules. Over months, this builds a powerful compounding effect. Adam's account keeps swinging wildly. Sarah's account, brick by brick, grows steadily. What do these two stories show us? Losses are not the problem. Both Adam and Sarah lost trades. But Adam saw losses as failure. Sarah saw them as part of the process. Discipline is the real edge. Adam's sabotage wasn't the market's fault, it was his inability to follow his own rules. Sarah's edge wasn't her strategy alone, it was her ability to stay disciplined under pressure. Journaling builds awareness. Adam never stopped to reflect on his emotions. Sarah logged her feelings before, during and after trades. That awareness gave her power. Small wins compound. Sarah's 2% gain may not sound exciting, but over 50 weeks, that's a potential 100% return with discipline. Adam chasing quick fixes burns his account. Now imagine Adam deciding to change. He studies his journal, the rare times he actually recorded his trades. He notices a pattern. Most of his biggest losses came after he broke his own risk rules. That's his sabotage trigger. So he makes a shift. He sets a hard rule: never risk more than 1% per trade. He programs it into his platform so he literally cannot break it. He also sets a daily loss limit. If he's down 3% in a day, he stops. The first week it feels frustrating. He wants to chase, but he forces himself to respect the limits. By the end of the month, his account is stable. He's not wildly profitable yet, but he's no longer self-destructing. The lesson: breaking self-sabotage isn't about never losing. It's about creating systems that protect you from yourself. Here are the key mindset changes Adam and every trader must adopt. Shift from chasing wins to protecting capital, because survival comes before profit. Shift from blaming the market to reviewing personal behavior, because the only variable you control is you. Shift from seeking excitement to valuing boring discipline, because boring trading is usually the most profitable. So ask yourself, are you trading like Adam, sabotaging your own progress, chasing emotions and burning capital? Or are you trading like Sarah, steady, disciplined, stacking small wins that add up to something big? The difference isn't talent, it isn't luck, it's mindset. It's the choice to break self-sabotage and embrace discipline. Because in the end, trading doesn't just test your strategy, it tests you. Every trader talks about discipline, but very few actually know how to build it into their daily routine. You can read books, watch videos, and study charts all day, but if you don't have a system, a structured action plan, you'll keep falling back into the same old patterns of fear, greed, and hesitation. The truth is, discipline doesn't just happen. It's designed. It's engineered. And if you're serious about trading like a professional, you need to build an action plan that makes self-sabotage almost impossible. Let's start with the step-by-step plan. The first step is identifying your triggers of self-sabotage. For some traders, it's boredom. They enter trades just to feel active. For others, it's revenge trading after a loss. Maybe for you, it's overconfidence after a big win. Whatever it is, you need brutal self-awareness. Write down what situations consistently cause you to break your rules. That's step 1. Step 2, document your personal trading rules. This isn't about copying someone else's strategy. It's about creating your own code of conduct. How much are you willing to risk per trade? What setups are valid for you? When do you stop trading for the day? These rules need to be written, visible, and non-negotiable. Think of them as your constitution. Break them, and you're betraying yourself. Step 3. Implement emotional checklists. Before you click buy or sell, pause and ask, am I calm? Am I trading my setup? Am I influenced by external noise? This simple pause acts like a mental checkpoint, stopping reckless decisions before they happen. Step 4. Track everything. Not just your trades, but your emotions, your thoughts, and your decisions. Did you feel FOMO? Did you hesitate? Did you break a rule? A trading journal isn't just about numbers. It's about understanding the story behind every decision you make. Step 5. Review weekly and adjust behavior. At the end of the week, don't just look at profits or losses. Look at your behavior. Did you follow your plan? Did you stick to your rules? Success isn't measured by money in the short term, but by whether you're evolving into a disciplined trader. Now, let's talk about creating daily rituals. Every professional athlete has a pre-game routine that gets them into peak performance mode. Trading is no different. Before the market opens, take a few minutes to ground yourself. Meditation, deep breathing, or visualization, these aren't soft practices, they're mental armor. Use a pre-trading checklist to confirm your rules, identify your levels, and make sure your emotions are in check. This way, you're entering the market with clarity, not chaos. And just as important as pre-trading routines are post-trading routines. After the market closes, don't just shut the laptop and move on. Journal your trades, reflect on your emotions, and reset yourself. If you had a winning day, avoid overconfidence. If you had a losing day, avoid revenge trading. The post-trading ritual is about emotional balance, ending the day clean, so you don't carry baggage into tomorrow. Finally, let's look at measuring success. In the beginning, most traders measure success by profits. But that's the wrong metric. Profits are inconsistent in the short run because the market is unpredictable. What you can control is your discipline. So at first, discipline should be your main measurement. Did you follow your plan today? Did you manage your risk? Did you avoid self-sabotage? If yes, that's a win, regardless of whether the trade was green or red. Over time, this focus on discipline leads to consistent execution, and consistent execution naturally leads to consistent results. Think of it like building a muscle. At first, it's not about how heavy you lift, it's about learning the right form. Once your form is flawless, strength follows automatically. So here's the bottom line: if you want to stop sabotaging yourself, don't rely on willpower, build systems. Identify your triggers, write your rules, use emotional checklists, track your behavior, and review weekly. Create daily rituals that prime your mind before trading and reset it after. And measure success not by quick profits, but by disciplined execution. Because in trading, you don't rise to the level of your goals. You fall to the level of your systems. Build systems strong enough to protect you from yourself, and the profits will come as a byproduct of discipline. If you've made it this far, you already understand something that most traders never do. The greatest threat to your trading career is not the market, not the economy, not algorithms, and not even bad luck. It's you. Self-sabotage is the silent killer of trading accounts, the invisible force that erases weeks of hard work in a single reckless decision. And it often doesn't feel like sabotage in the moment. It feels like taking control, getting back what's mine, or just one more trade. But as we've explored, those moments of emotional weakness are where traders lose everything. Let's recap the dangers. Self-sabotage shows up in many disguises: overtrading after a loss, chasing setups that don't exist, ignoring stop losses, moving take-profit levels, or breaking risk limits because this one feels right. Each of these decisions chips away at your account, but more importantly, they chip away at your confidence and your discipline. The danger isn't just financial, it's psychological. Every time you break your rules, you reinforce the belief that your emotions control you, not your plan. That belief is what destroys traders. But here's the truth worth remembering: self-sabotage is not inevitable. You are not doomed to repeat the same mistakes forever. By mastering your mindset, strengthening your discipline, and practicing emotional control, you can create an environment where self-sabotage simply doesn't have room to exist. And that's the difference between traders who stay stuck for years and those who rise to consistency. Discipline is not about being perfect. It's about creating systems that catch you when you're weak. When you set clear entry and exit rules, risk caps, and emotional guidelines, you're not just creating structure, you're protecting yourself from yourself. A professional trader doesn't trust their emotions in the heat of the moment. They trust their plan. They know that their long-term success is built not on one trade, but on thousands of trades executed with discipline. Emotional control is the second pillar. You can't eliminate fear or greed, but you can learn to recognize them and stop them from hijacking your decisions. That's where mindfulness, journaling, and rituals come in. These aren't fluffy, nice-to-haves, they're performance tools. A trader who pauses to breathe after a loss, who journals their emotions, who walks away when frustration builds, that trader has already won the battle that 90% of traders lose. And then there's mindset. You must shift from chasing quick wins to building consistency. Many traders sabotage themselves by obsessing over profits. But the truth is, profits are just a side effect of behavior. If you master your behavior, your patience, your discipline, your ability to stick to your edge, the money will come. If you chase the money without fixing your behavior, you'll always end up back at zero. Consistency doesn't come from luck, and it doesn't come from the perfect strategy. It comes from showing up every day, following your rules, and treating every trade as just one small part of a bigger picture. So what are the actionable steps to stop self-sabotage? They're simple but not easy. Write down your rules. Stick to your risk limits. Journal your trades and emotions daily. Review your behavior weekly. Build rituals that prime you before trading and reset you after. Surround yourself with accountability, whether through a trading community, a mentor, or your own journal. And above all, measure success by discipline, not by profit. Ask yourself every day, did I follow my rules? Did I trade with discipline? If the answer is yes, then you are already succeeding, even if today's P&L is red. Let me leave you with this: the market will always test you. It will tempt you with opportunities that look perfect, but don't fit your plan. It will punish you with losses that make you want to fight back. It will dangle quick wins in front of you to lure you into greed. And in those moments, the only thing standing between success and failure is your ability to control yourself. Consistent trading is not about predicting the market. It's about mastering yourself. It's about showing up every day with the mindset of a professional, not a gambler. It's about realizing that trading is not a sprint, but a marathon, and the winners are those who conserve energy, follow the plan, and let small wins compound over time. Remember, discipline and self-control are not just trading skills, they're life skills. When you prove to yourself that you can master your impulses, that you can stay calm under pressure, that you can stick to a plan even when it's uncomfortable, you're not just becoming a better trader. You're becoming a stronger, more resilient version of yourself. And that's the ultimate reward. So take this as your final takeaway: the market doesn't reward the smartest, the fastest, or even the most knowledgeable traders. It rewards the most disciplined. If you can stop sabotaging yourself, if you can make discipline your default and emotional control your shield, consistency will no longer be a dream, it will be your reality. Because in the end, success in trading is simple: master your behavior, and the results will follow.